Hello there, how are you? This is Christopher Aaron. Welcome. It is October 17th, 2018. We are going to look at this topic. Something happened after last week's broadcast. We saw a severe sell-off in the stock market, a nice move in the precious metals. I want to talk about this because this is fitting in with the major long-term macro thesis that we have here that is on the table as a proposition for what we expect to be happening in the world markets in a broad stroke of history. We're talking over the next decade or so. So I want to take a look at this topic. What happened last week? Let's put this into perspective for a moment. Really quickly, I just wanted to say thank you very much to those people who donated onto the Patreon site. I just wanted to say thank you. And also just to let you know, that's available. Some people had said that they did not want to subscribe to the premium service, which I totally understand, but they wanted to show a way of saying thanks. So that is available for you in the link below. Once again, thank you for that from the bottom of my heart. Let us look at the turmoil that happened last week. There were a number of articles that came out about this, and we are talking, of course, about what turmoil in the bond market, okay, specifically the United States bond market, front and center. Largest bond market in the world, of the largest debtor nation in the world. We were talking about investors being concerned about rising interest rates, right? And even Warren Buffett is now getting on the train and talking about it. Where was he a year and a half ago when we saw those signs of the bond market topping? Well, he wasn't talking about it then, but here he is talking about it now. I'm just showing you what's happening in the mainstream news. And let us take a look at the market reaction to the rising interest rates. Now, these are the 2 days, Thursday and Friday, in which we saw the most severe reaction from last week. Take a look at this. The U.S. S&P 500, this is the stock market. This is the largest 500 companies in the United States, down over 5% in 2 days. Commodities getting hit as well. Generally, when we see this kind of severe sell-off in stocks, commodities will get sold with stocks because there's a large industrial component that is interlinked between the two. Look at what served as the safe haven asset here, gold, up 2.8%. Now, one of the things I want to draw to your attention, and we'll look at a comparison here with what happened in 2008. Look at the senior gold miners. We're talking about the HUI index, what happened in these 2 days alone. Completely ignoring the trend in the stocks, but leveraging gains in gold. When we look at the comparison here in just a moment, you'll see how incredible this is, because what happened in 2008 is that the gold miners fell even more than the stock market itself. They did not leverage gains in gold whatsoever. Now, ironically, bonds, which caused, as we just looked in those articles, bonds, which caused the sell-off in the stocks, then saw an inverse flow of funds, and bonds ended up rising in the last 2 days of the week in sort of a counterflow. U.S. dollar was weaker in huge comparison. So let's just pull this up. Now remember the flow here that we saw in a market panic, in a stock market panic. Remember this flow, and let's switch over and let's look at what happened in the most severe part of the crash of 2008. Now, I really cut my teeth on this time in the markets. Most of my investment career began in the mid-2000s, and I dabbled in a number of things. And then I really began to focus on the precious metals in the mid-2000s, and especially in this period around 2008. And just look at what happened. This is the most severe time of the crash in 2008. If you did not live through this, in other words, if you graduated college after 2008, and so you kind of started to pay attention to the markets in 2009 or 2010, let's say, I just have to tell you, this was one of those periods that you will never forget. You will absolutely never forget this. So as the stock market lost almost a third of its value in 3 months alone, we're talking July, August, September, into October of 2008, stock market lost a third of its value. Look at what happened to gold, right? Gold sold off with the stock market. It did not rise as we just saw in the last slide. Gold sold off with the stock market. And when gold and stocks both decline, my God, look at what happened to the gold miners, losing over 60% in just over a quarter of the year. Right? Now, what did serve as the safe haven was the U.S. dollar. Look at this, 20%, and U.S. bonds serving as the safe haven. So this is why I think it's so important to monitor these trends as they are developing. Literally, looking at intra-week analysis like this in these mini panics, and then looking at broader trends. I just remember leading into the crash of 2008, so many individuals, I won't name their names, but if there's people who you like to follow who are fundamental-based analysts for the precious metals right now, you know who they are. Go back and see if they were saying this same kind of thing in the spring and the early summer of 2008. Most of these people were completely blindsided that the gold miners would fall more than the broad stock market itself. Completely blindsided. I like to pull up this little cartoon here because I just think so many people, I remember this, were expecting that if gold was going to rise as stocks crashed, then the gold miners would rise. And exactly what happened was gold fell with the stocks and gold miners leveraged those losses. And so we turn back to the action over the last few days. This is why this is so important. Look at the action in the gold miners as the stock market fell over 5%. Look at the action in gold. Look at the US dollar not serving as the safe haven of last resort in this little mini panic. Now, 2 days, as we say, 2 days or 1 week does not make a long-term trend. So we're comparing 2 days here with the 3 or 4 months of the most severe part of the crash of 2008. And we want to be very careful that we don't assume this is going to happen over a longer term period. But this is why week in and week out, we follow these trends to start to notice what is happening here when this bigger picture thesis starts to come. What is happening to the precious metals? Are they serving as a safe haven or are they not, as we saw during the crash of 2008? Why is this so important? We're talking about, once again, let's bring it back to the bond market. We were seeing those mainstream articles talking about the bond market. Why is this so important? Look at where the bond market is right now. At the lower parallel of a 38-year channel that showed signs of becoming disorderly to the upside. This type of parabolic curve after a multi-decade advance tends to be the signature. It tends to be the signature that markets take when they are getting ready to reverse in a major way to the downside. So if this kind of, and we were just talking about basically this drop here from 145 or so on the index down to 138 where we are today, 137 and change. It was this drop that caused that little panic in the stock market that we saw. But what I'm telling you is that we haven't seen anything yet for the U.S. bond market. Because when this lower parallel channel here breaks, I believe we are going to see a decline that really wipes out a number of years of gains for bond investors within several months alone. When you see a channel like this that is forming over multiple decades and then you break a channel, basically we don't have that many examples of multi-decade channels like this to compare it to. We do have sometimes, you can look at, gold formed an example like this from 2001 to 2011. So it was a 10-year channel. And then we saw this type of signature. And then what happened? Gold lost almost 50% of its value from 2011 to 2015. So what's going to happen when we have a 38-year channel in the U.S. bond market and this thing cracks? This is the big question. Will those trends that we just saw in the 2-day time frame continue, and will gold continue to act as the safe haven of last resort when bonds break and stocks break at the same time? This is the thesis. The thesis is that they will, but as I've said before, there were a lot of well-meaning individuals in 2008 who basically walked their followers off of a financial cliff by assuming that the precious metals would serve as the safe haven of last resort, when in fact they got clobbered. So I think we need to be very careful of assumptions. That is why we follow these markets week in and week out. I do not see any other way to truly see how the trends are going to shape up unless we continue to follow the markets week in and week out. I just don't know any other way. I believe you will miss something if you take your eyes off of these intra-week comparisons. You'll miss something at just the most important time. The premium service that I offer allows us to follow these in a logical way. We send flash updates right to your inbox when something important is happening, as happened last week. Last Thursday, members received a flash update. We do videos like this, much longer, much more in-depth, covering everything you need to know once per month. We cover physical gold, physical silver, the mining sector, and the individual miners that we are investing in here, with all the fundamental research to back those up as well. I do prefer to study the charts, but I know we have to understand the fundamentals that are happening in the background as well. You can find more about that on the website. And if you would like to speak to me one-on-one, please know you can do that. There's a consultations tab for an hour consultation or for an email consultation as well. If you have a unique situation that deserves an independent answer from someone who doesn't sell the metals, I understand the metals, but I don't sell them. So if I think you're overexposed, or if I think you are over leveraged in a specific kind of way, I don't have a problem telling that to you. It's not always just buy, buy, buy. Once again, thank you to those who supported me on Patreon. I very much appreciate it. This is an exciting time because we're seeing this thesis. We've been talking about this thesis of a top in the U.S. bond market. We're following this very closely. But we've been talking about this thesis and how who here has been alive long enough to remember the last bond bear market? If bonds bottomed in the year 1980, they've been rising for 38 years. You have to have been engaged in an investment career starting in the 1950s through the end of that bear market in the 1970s. I don't mean you were born in the 1970s. You have to have been actively investing in the 1970s. So I would dare to say most people don't remember what a bond bear market can do to equity prices and to precious metals prices. This could be an exciting time. Then again, something could go wrong with the thesis, and that's why I'll be here most every week. Not every single week, but most weeks as we watch this thing play out.